For the Galatasaray fans, I give you my commiserations. For the Fenerbahce fans, congratulations. I'm sure the fans of Fenerbahce are still in bed, to be honest. As mentioned, I'm kind of known for fintech, mainly because I've been blogging about fintech for over 10 years, every single day. I have a blog called thefinancer.com, and every single day I write something new about fintech, which is lighting up the world, hence the shoes. But it's not just about fintech, it's tech and what the internet is doing that's lighting up the world. And that's the reason why Startup Turkey and startups generally around the world are so important. The reason why I'm known as Mr. Fintech is not just because I have my blog, but also because I've written some books about banking and the future of financial services. The last one, called Digital Bank, is available here in Turkey in language translation, thanks to BKM, sponsors and hosts of Startup Turkey. And it was mainly about how banking has been built over the past 3 centuries for the physical distribution of paper in a localized network supported by buildings and humans. And now we're going into this new world of the digital distribution of data as a currency, as a value, focused upon software and servers in the global network of the internet. And the challenge for banking is how to turn from physical thinking to digital thinking. It's really difficult because to create a digital foundation that has buildings and humans on top is counterintuitive for most banks who have built a physical foundation with the internet on top. Doesn't work. And as I say, it's for the interchange of value through data, and value is no longer currency and money, it's ideas, it's air miles, it's airtime, it's minutes on the network, it's whatever you want it to be, bitcoins, it's data. And that's what the new book that hasn't come out yet, it's coming out next month, is all about, which is the value web, which is how fintech companies are using embedded chips for the Internet of Things, supported by blockchain technologies that came out of Bitcoin, to create an Internet of value that is immediate and free. And that really challenges the traditional financial companies. So I'm going to talk about this theme of the exchange of value through the Internet and moving financial services to the Internet, and how it challenges the traditional 300-year-old system that we've built. So the value web is really representative of a third age revolution in networking, which is actually what startups is all about, because we are now connected globally, one-to-one, person-to-person, every single person on this planet through the network. And that is a revolution. We've never had that before. 7 billion people able to send a text message to each other one-to-one immediately and receive and send immediately. That is fundamental transformation. And that revolution is kind of the third revolution. You may say there's been others, but I think in commerce, we've only really seen 3 big revolutions. Sorry, it's a slide. Gotcha. Sorry, I had the team worried there. It's just a slide. I just wanted to illustrate that this revolution is really young. It's not really formed itself yet. The first computer was invented in 1946 called the ENIAC to forecast weather. And 70 years in a revolution is actually very young. And we've got a long way to go. In fact, if you look at the previous 2 revolutions, the big ones, the agricultural revolution, the industrial revolution, the agricultural revolution took hundreds of years to emerge, and it came out of ancient Sumeria as we moved from nomad populations to farming and villages populations. Finally, we could settle and sow seed on the land and create abundance of goods. And in so doing, the exchange of barter broke down because we had the abundance of goods. We suddenly had more wheat, barley than we needed, so we could exchange something that no longer was available for demand. No one wanted it. There was too much of it. So we invented money. Just invented it. And it was the priests of the temples of ancient Sumeria that invented the ancient shekel that was backed by gold and silver over time that formed the main ecosystem of value exchange once barter broke down. Then we had this other revolution, the Industrial Revolution, which I think really places itself based on the use of steam as a power source. And the first patent for a steam power source was a steam pump in 1606. The last patent for a steam power source was a steam-powered aeroplane in 1933. I kind of don't think I want to fly that one. But 330 years from the start to the end of that steam cycle is kind of the Industrial Revolution. And we invented a new system in the Industrial Revolution called banking. And most banks in most countries go back to the period of the Industrial Revolution. They were created by the governments to enable us to exchange value in another form other than gold and silver, because gold and silver commodities are very heavy to transport. And this was a fast-moving society using the steam engine to go across continents, to go across nations, to go across regions, to go around the world. So he created a paper form of money, the checkbook, which is only trusted because governments gave banks licenses to issue paper. That's the nature of the foundation of the last Industrial Revolution. What was interesting about the Industrial Revolution, as demonstrated here by Lloyds Bank, which celebrated 250 years last year, is the focus on horses. And horses were really a focal point during that Industrial Revolution because it was our main form of transport other than trains. The horse and carriage is this lovely idea of ladies in fine clothes being transported to country houses to be wooed by Darcy and Pride and Prejudice or similar fairy tales of the 19th century. The truth was that cities and towns were full of horse manure. They smelt terrible. They had poo everywhere. It was awful. Loads of horses producing loads of crap. And every street full of people having to dig this out and get rid of it. It was a massive problem. And the vision at the time to solve this problem, because in 200 years society ago, we didn't have the idea of the engine that we have today, they invented the steam-powered horse. You know, this is a vision from 1820 of the future society, and this is the steam-powered horse to get rid of the crap on the streets. Faster horses, as Henry Ford would say. So we're constrained by where we are today, and we have no idea where our revolution in the network world is going to go. But what we do know is that it's going to get rid of the forms of value exchange we created for the Industrial Revolution, such as the checkbook and the paper-based check. Because this is not something that works today. I mean, the idea of putting a check in the post with a stamp on a letter seems ridiculous in the internet age. We still do it because it's still accepted, but it's going to go away because it's slow and expensive. And in the internet age, if I send you something that takes 28 days to process, as happened to me recently with a check from the USA, and cost me $250 to get processed, that's ridiculous when we call each other and expect people to pick up immediately. We tweet each other and expect you to reply immediately. I do not expect 28-day cycles of exchange. And that's why fintech is so hot, because we have this globally connected world that's replacing the slow and expensive financial system with a fast chip-based system that's immediate and almost nothing in cost. No overhead to pay for the exchange of value through the network-based economy. And that's the value web, this new generation of financial services. And you have to have a value web to have an Internet of Things. You cannot have an Internet of Things if you do not have this fundamental financial exchange system underbedding the system of the internet. The reason being is that if my television wants to order the next season of Game of Thrones, I do not want it to take 28 days and cost me dollars to get it. My television expects to get it immediately. I've authorized my TV to do that. So how have I authorized my TV to do that? I have a digital identity. Where is my digital identity? It's on some form of shared database. Who runs the shared database? Bitcoin? I don't think so. And my digital identity will have lots of other things that are authorized on my behalf to get goods and services. My car can order fuel. My home can order oil. My shoes can order replacement heels. Whatever can order anything if I've authorized it through my digital identity on a shared database of the internet. And it should happen immediately and cost virtually nothing. That is the value web. So let's just look at the value web in a little bit more detail, because the technology of real-time has started with the mobile telephone and mobile devices. But the mobile is really just a chip inside a phone. Take the chip out of the phone, stick it in shoes, handbags, walls, ceilings, earrings, cars, homes, anywhere. That's the Internet of Things. Everything becomes intelligent, everything can communicate, everything can transact. And right now, if you look at what's happened with mobile in financial services, it started with text messaging devices in 2G systems, GSM, and now we're in 4 and 5G with smartphones. And the smartphone shows the virality, the immediacy of this global connectivity of 7 billion people. Let's just take a fintech startup as an example. You may know them, you may not. This is Ikram and Andy, 2 millennials under the age of 35 who created an app in 2011. And the reason they created the app is because Ikram went to spend the weekend with Andy and forgot his wallet. And so through the weekend, they kept a score of what was being spent. You know, coffee, newspaper, magazine, sandwich, panini, whatever. And by the end of the weekend, Ikram started to write Andy a check to pay for the $58 he owed for the weekend, or however much it was. And then they looked at each other and thought, this is really stupid. We both use PayPal, we're both developers, we love technology. Why am I writing you a stupid check that will take 3 days to process and cost dollars? We both use PayPal. Why didn't we use PayPal to do this? Oh, because PayPal is actually for big items. You know, can't do coffee via PayPal, magazine via PayPal, panini via PayPal. Yes, you can, they thought. So they created an app called Venmo, an app that does social, small transactions through a weekend over PayPal in a quick and easy way. And they got bought by Braintree a year later for $26 million. Braintree is an online payments company designed for mobile that raised the interest of PayPal, which was bought by PayPal in 2013 for $800 million. And PayPal discovered that they had this little jewel called Venmo that had been created over a fun weekend by 2 millennials who decided they wanted to make things easier in terms of how they pay. And Venmo is now the biggest social payment system in the world, processing $2.5 billion in Q4 2015, over $10 billion a year being processed by an app created over a weekend by 2 young guys. That's the nature of the virality of the mobile smartphone network that will become the Internet of Things. The things will use Venmo to order. You don't have to use yourselves. And this development mentality amongst the startups and the fintech community is illustrated really well by these 2 guys who were the powerhouse behind the Barack Obama 2012 election campaign. After they helped to get Barack Obama into power through running their social media services, they created an app called Modest, which helps to look at the context of where you are, what you're doing, and leverage that knowledge to make you get more things you like. Maybe spend more if you have the budget. And because of that, PayPal brought them last year. But when you look at these 2 guys and compare them with bankers, it's kind of difficult to see how they get on, because they're 2 very different beasts. One wants to destroy the system, one wants to protect the system. One focuses on disruption, the other focuses on stability. One focuses on create the new world, one focuses on maintain the current world. Banks were created by governments to stabilize economies. Destroy that system, you destroy the economy. We'll come back to that maybe, because that gets into the Bitcoin discussion I'm going to come to later. But just before we get into that, let's look at the fact that it's not just this virality of the immediacy of smartphones, but the phone itself is a phenomenal device. Because suddenly you can get a phone for $1 in a society that lives on $1 a day. Now you have a device in your hand, even though you may be the poorest person in the world, that will get you out of poverty. Because you can do things on a phone you could never do before when you were disconnected from the network. Now you're on the network, you can be really entrepreneurial, as demonstrated by Africa and other emerging nations, the Philippines, Indonesia. Because what's happening here is that every single person who gets a mobile subscription gets a mobile wallet. And once you have a mobile wallet, you can transact and exchange value. Once you can transact and exchange value, you can buy stuff, which gets you connectivity. You can send stuff. You can send money to your mum who lives in a village 400 miles away whilst you work in the city. That's transformational in these economies. It's the reason why in the developed markets in Africa, like Kenya, Nigeria, South Africa, you're seeing all of the African community opening a mobile phone with a wallet. You know, most people in developed economies don't have a mobile wallet yet, or if they do, they don't use it. These guys use it all the time, transacting billions of dollars in small numbers through mobile networks. And the mobile network providers are collaborating so that you can do this across borders for nothing, because the banking system and Western Union charge a lot. You know, Vodafone, T-Mobile, and others are saying, we'll work together to make it transact for nothing. So Kenyans can send money to Nigerians for nothing, near nothing, immediately. Transformational. This is from the M-Pesa website in Kenya, and it shows a cattle farmer who historically has sold milk, meat, and leather to the local village. Now he's got a phone, he can sell milk, meat, and leather across the whole of Kenya. He can sell milk, meat, and leather across the whole of Africa. He could sell milk, meat, and leather across the world because he has an Instagram account to take photos of his cattle. He's got a Facebook page to show what they're doing. He's got an M-Pesa account to take and receive payments. So everybody on the planet has a point of sale in their hand. That's transformational. 7 billion people can buy and sell stuff. So we have this wonderful connectivity through the network of mobile and internet that enables us, and soon our things, to transact in real time immediately for quite a lot of money because we have a banking system, and the banking system's expensive. It needs to be free or near free. And that's what's really happening with peer-to-peer connectivity structures, crowdfunding, lending, payments. In fact, the one key technology that's really transformational here is what came out of Bitcoin, which is the blockchain. Nothing to do with Bitcoin now, although some say it has to be based on Bitcoin. That's an argument we can have. It's an argument debate you can have. But really, when you look at blockchain, it's become like big data and cloud, a terrifying discussion of a generic word that means nothing. If you're not familiar with blockchain, I'm sure some of you are because this is Startup Turkey. Blockchain is basically a shared database on the internet. It, as a shared database on the internet, is providing a proof point for the exchange of value for everybody, because once you put something on a blockchain shared database, you can prove it happened. This transaction happened on this date at that time between this person and that person. And that can record anything. I mean, initially it was recording Bitcoin transactions, but it can record anything. It can record the sale of a house. It can record the contract of marriage. It can record the contract of divorce. It can record a payment. It can record the clearing and settlement of something on the equities trading networks. In fact, in fintech, the big dollars this year are going into shared database internet structures using blockchain protocol technologies. This is just a bit of the ecosystem. In fact, if you look at one part of that ecosystem, the financial infrastructure is being attacked. I mean, this is just the companies involved in clearing and settlement, which is on the capital markets exchanges. These are fintech startup companies that are rapidly growing credibility because they're being designed and managed by people who have credibility, like Blythe Masters, who's the lady who formerly worked for JP Morgan creating credit default swaps formulas. Now she runs Digital Asset Holdings, a blockchain-based clearing and settlement system being used by the Australian Stock Exchange. And it can be used, as I say, for lots of other things, in insurance, in government. I mean, UK government just came out with a white paper 2 weeks ago saying we're going to use this technology for tax collection, passport issuance, benefits distribution. You can use it for anything that needs a provenance, a proof of record, a digital, trusted, shared database that says this thing happened on that date, at that time, between these two people. That's what this is all about. And this revolutionizes everything, not just financial services, but government. And it's why fintech is so hot. Billions of dollars going into fintech, as Oscar mentioned. And for banks, going back to why it's challenging for banks, because they're built on buildings and humans. So if a bank wants to connect people who have money with people who need money, they need to have a big margin to cover the cost of the buildings and humans. Do it on software and servers with algorithms, it costs virtually nothing. So the percentage margin differential is collapsed. A bank needs that margin differential to pay for the buildings and humans. And what's going to happen in 10 years is we're going to see 80% of the financial infrastructure of branches being eradicated. It's got to go. You can't afford to deal with it anymore. It's digital distribution of data. No longer do we do it with humans and buildings. Fintech startups are hot because they're taking anything a bank does and saying, I can change that. I can do it for a lot less, and I can do it really well because I'm really focused on a very narrow part of the banking system. This is called the great unbundling of banking. And in unbundling banking, we've seen the rise of unicorns. Does anyone know what a unicorn is? Yep, a couple of hands raised. Does anyone want to be a unicorn? A couple of hands raised. Maybe you will be in a few years. This is Startup Turkey. A unicorn is $1 billion or more valuation for a startup company. $1 billion valuation or more for a brand new company. These are unicorns in financial services. These are companies that are 5 years old on average or less. These are companies like Venmo, but Venmo is owned by PayPal. PayPal is kind of a unicorn, but they started before 2000. So really a unicorn is after 2000. Startup companies in the last 15 years now worth over $1 billion. And they're called unicorns because they're very rarely seen, but there actually is no such thing as unicorns.
Où sont les licornes?
Oh, Sam.
There's no such thing as unicorns. They missed the boat. We love to talk about unicorns in fintech because it's exciting to have this idea that a brand new company, 5 years old or less, can be worth billions. But in reality, it's smoke and mirrors. It's not true. You know, we have companies with great ideas that might be worth a lot sometime in the future. But today, we're overvaluing these companies because we're in a bit of a bubble. For example, TransferWise connects people through data to transfer money across borders really cheaply. They're a great company, actually. I mean, they've just formed an alliance with a bank called Number 26 in Germany to create a new global bank that's cheap, free, and immediate real-time. That's what the vision is. But to value a company at over $1 billion that today only has sales of $10 million seems a bit ridiculous, especially when some of these companies are going bankrupt because they run out of money. Power was a fintech unicorn. They've just gone into receivership because they ran out of money. This is what happened in the internet bubble. It bursts. But when it bursts, you still have some companies left, like Amazon, Google, Facebook, that are actually worthwhile. So there are worthwhile companies that are being created in this new fintech ecosystem. But I don't think we should be looking for unicorns. What we should be looking for is business models that work. And there are a few. I mean, peer-to-peer lending, crowdfunding, is definitely a marketplace that will challenge the traditional financial system because it offers a new form of credit. For some, it's serving new markets that were underserved, like small businesses, students. But it's also serving core markets that banks serve, which is the reason why Goldman Sachs believe that about 20% of lending that traditionally has been delivered by the banking system will move to these new startup companies over the next 5-10 years. That is actually a core change because that's actually going to be a new marketplace estimated to be worth $1 trillion in lending by 2025. So there are going to be, there's unicorns here. And the betting is in which one will be the winners. Prosper, Lending Club, Funding Circle, Sophie, Zopa, PPDI. No, I mean, there's companies here that will win. And the question is which ones? And that's what the angels and the VCs are all looking for. Unfortunately, the banks aren't looking for them because they don't know that they exist. It's a survey of European banks, 110 decision makers at the boardroom of European banks. And these are all fintech unicorns. I've mentioned some of them already. They're in different spaces, but what's embarrassing is that the only one that everybody had heard of was PayPal, and yet even then, 1 in 10 decision makers in banks have no idea what PayPal does. Whew, that's a bit embarrassing. Most of them don't have any idea what the unicorns do because they're not even looking at them. And that's where you have the threat, because the impact upon financial institutions is if they're not looking. It doesn't mean they have to change. It doesn't mean they have to re-engineer, reimagine, rebuild, although I think they do have to rebuild because they have to rebuild onto the internet digital foundation. But they have to certainly be aware of what is happening, because it is going to change. It's going to change slowly because money is more important than selfies. So it's not like the Snapchat of banking will appear in the next day, but it might appear in the next 5 years if we're looking. And when you look at what banks do, they have this operational model of front, middle, back office, retail, processing, manufacturing. And then they have lots of things they do across all those areas in terms of lots of line of business. And over the past 15 years, you've seen some companies try to become massive universal global banks that do all of these things everywhere. And that's actually being ripped apart by regulation, because we're saying that investment banking must be separated from retail banking because it causes failure, systemic risk. That's what happened in 2008. So get rid of the investment banking piece, because our citizens and our companies and our countries must be protected from collapse. But equally, technology is ripping apart this business model, because in the front office, the mobile user experience and soon our Internet of Things experience needs to be simple, easy, and quick. Not complicated, not boring. It needs to be entertaining, to be honest. In the middle office, we need to have everything happening in real time, immediately, now, not in 28 days. So we can do that by open sourcing the bank, open API, everything. That's happening. In fact, regulation has started to force that to happen. And in the back office, we need really good leverage of our knowledge of customers through data analytics via the cloud into those APIs to the front-end user experience. And have all this on a shared database so it's cheap. That's the reimagining of banking with technology. And it is happening, whether the banks like it or not, because the fintech startups are doing this. Fintech startups have taken each piece of this and said, we can do this better on software and servers. We can reimagine this. And what banks need to do is start to look at these fintech startups and say, in the back office, maybe these are just components of financial services that we can use. Maybe we can take these components through the cloud into our APIs and integrate them through our APIs into a fantastic user experience at the front end that's an aggregated structure for our customers that gives them the best possible delivery and choice that they need. And that's exactly what banks are becoming. They're becoming systems integrators of value exchange. BBVA is a software house. They've stated this publicly. Most banks are just technology companies, but we've known this for decades. Citibank in the 1970s said that banking is just bits and bytes. It's just taken 50 years to realize it. But the internet has changed the game, which is why startups and fintech are so hot. And actually what's going to happen is that this unbundling of banking will eventually become the rebundling of fintech as banks wake up and start to integrate and partner and acquire and use the services that fintech startups offer them. So I'm just going to conclude with a couple of thoughts about the future, which is actually nothing to do with the value web, but it's to do with this revolution we're going through and the fact that it's still really young, because we've got a long way to go before it's going to really play out, at least another 200 plus years. So what can we do in 200 years? Well, you can do lots of things. We're doing them straight away. This is someone's finger holding a camera. This camera gives high definition analysis for doctors of what's inside you before they do a surgery. They can check out your heart inside the heart, or your kidneys or lungs or whatever they need to look at before doing surgery in high definition. They can actually grow your body parts in beakers to replace them if you lose something like an ear or an arm An arm maybe is more difficult to grow in a beaker today, so we grow it as a bionic arm. It's already here, Claire Mitchell in the States with her bionic arm. So we have some machine inside the human, but we're going to have some human inside the machine, because we definitely have robots coming. When? Who knows? But it's not far away. As a result of having all these life sciences and nanotechnologies and replacement body parts and the ability to act with surgery upon us, doctors believe that a child's been born in 2016 who will live till 2166. What are they going to be doing for 150 years? And what's their pension going to be? When do they start their pension? Big questions. Our homes are all connected. Our cars are all connected. As our cars drive themselves, who needs insurance? The auto insurance industry caves in. We might actually be looping ourselves around networks in super high fast trains, like the Hyperloop that Elon Musk is talking about, 800 miles an hour, moving us from San Francisco to Los Angeles. Initially, people thought it was a joke. Now they're building it. Just as he's building a reusable space rocket to colonize Mars. And maybe in 200 years, the whole thing about Star Trek, Star Wars, is realized. And you never saw Luke Skywalker or Captain Kirk get their wallet out to pay for anything, did you? Thank you.